You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have British American Tobacco, PZ Cussons, Unilever, BP, Redrow, and our US company of the week is Disney. Sam, shall I kick us off with British American Tobacco?
Absolutely.
Okay, so cover it a fair few times on the show. It is one of the biggest listed companies on the FTSE 100, and it's the largest of the tobacco companies. It has brands such as Lucky Strike and Camel. Anyway, they had their full year results out this week, with full year revenue rising 2.3% to £26.3 billion, excluding the effect of exchange rates, with a small decline in traditional combustibles being more than offset by the increase in the next generation products, which rose by 37% to £2.8 billion. Revenue for e-cigarettes was up 54.9% at £1.4 billion, heat not burn up 24% to just over £1 billion, and modern oral up 45% to £398 million. And interestingly, Vuse, which is the flagship e-cigarette brand, was the market leader in 35 US states with a 40.9% share of the US vapor market and delivered 62.9% in revenue growth in the US alone. Traditional combustible volumes fell by 5.2%, but revenue was down only 0.6% at constant currency with the price rises. Underlying operating profit was 4.3% higher at £12.4 billion, which was up the top end of guidance with better than expected cost savings of £1.9 billion. Free cash flow came in at £8 billion, up 8.1%, but net debt also rose by 8.2% to £39.3 billion with foreign exchange movements. Adjusted net debt to adjusted EBITDA ratio stood at 2.9 times. My thoughts on these results, I thought they were very good. The combustibles is broadly, I think, what we would expect. It's declining by low single digits and fewer people, particularly in the West, are smoking. But I guess investors are really looking towards those next generation products, e-cigarettes being some of them, and they've delivered whopping growth on that. In the US alone, it was 62.9% revenue growth, and they're expecting profitability very shortly. I suppose the big concern, well, there are ethical concerns, and that's one of the reasons that the share price is depressed. But the other big concern is from a regulatory point of view of those next generation products. I think that's priced in, given that it's just 7 times 7 forward earnings, when they've got those new next generation products growing so rapidly, as well as, for the ethical reasons, a lot of people are sort of not buying it, particularly in active and sort of passive investments from an ESG perspective. But I think for me, it would be that regulatory side that is particularly holding the shares back in that next generation products, which currently is driving the growth of the company. Sam, what are your thoughts on British American Tobacco and the valuation?
I'm really impressed with these results. I think for me, what stuck out is that the increase in new categories was high enough to offset the decline in combustibles. I don't know if that's the first time it's happened, but it's the first time I recall it happening. And if they can carry on doing that for a few quarters, where actually the cigarettes are dropping off, but the new categories are making up for it, I think it's very, very underpriced. I know partly the reason it's so cheap is for ethical concerns, but it's also partly because it's a business in terminal decline. That's why you get it so cheap. We talked about it numerous times before. It's priced as if it doesn't have a future, and actually the non-combustibles are doing so well that suggests it might do. But this is even more strengthening that than what we've said previously, because it's now for the first time actually. The previously the figures were encouraging because the growth was so high, but it was off such a small base, it wasn't really making a difference. Whereas now, okay, it's still on a small base, but it's now big enough to start making a difference, or at least it is with those growth rates. I do like the business a lot. I like the brands a lot. I like the industry a lot, actually, as well. I think ethical concerns aside, it does help when the product you're selling is addictive. I don't know what government policy is going to be in terms of the new category, but I don't know. I think it would be a mistake to start increasing the regulation on it at this stage. And this, I don't want to get political because this isn't a political show, but I did actually read a book this week, and it was about, I'll just get it. It was Pandora's Lab, and it was 7 stories of science gone wrong. It basically talks about 7 scientific inventions and how they've been used for subsequently used for terrible things. So, but then at the end, it talks about what we can learn from it. And the main takeaway that it gave is that really it's all of these things could have been prevented if people actually just looked at the data and actually rather than sort of making emotional decisions. And he actually gave the example of e-cigarettes and basically said, when you actually look at the data, and he explains it much better than me, and I've not really remembered any of the facts from it. But he basically talks about how, when you actually look at studies of where you can get e-cigarettes compared to where you can't, there's nothing suggesting that the e-cigarettes are being used as a gateway to smoking. And if anything, more people are using them to stop smoking. And they're a much more effective method than, I can't remember how much more effective they are than the gum, but they're a lot more effective. And there's not really any evidence at the minute although it is the narrative that is spun, there's not really any evidence in terms of the data that people are using the e-cigarettes as the gateways to traditional smoking. There might be people doing the e-cigarettes that are then staying on them that never would have smoked at all. But there's also a lot of people that are not going on to smoking because of the e-cigarettes. So it is quite a good book and worth a read, actually. But yeah, I like it, and I think it's very reasonably priced.
Yeah, and I suppose that it's part of the problem in terms of the regulation. That would people be following the data, or would they just be taking a political view on it, therefore imposing quite stringent regulations which could literally choke it off? Who knows?
I think a lot of it though, I think the politicians are almost and the whoever it is that's meant to be advising on it, they are driven by the public perception.
Yeah.
And when you, for example, let's say next week there's an e-cigarette that blows up in a teenage girl's face and it just ruins her face. That's going to be all over the front pages. That's what people are focused on. It won't matter that overall it's so much. And I'm not saying that they are likely to blow up in teenage girls' faces, but if that were to happen, that would make a huge difference, even if it was just an anomaly and the data showed that. I think politicians would go for the easy win of just banning it because it looks like they're doing something, even if in the long term it's actually making things worse.
Yeah, and then they're not going to have very much sympathy for the views of Imperial brands and British American Tobacco if they don't like it. And then obviously the big players. And then I suppose in the UK you've got Supreme too, but British American and Imperial being the really big ones. Anyway, it's not an expensive stock regardless. Shall we move on to another stock? Well, this is fairly priced, isn't it, Sam?
It's certainly pricier than a tobacco company, but most I think that will be the case for all of the companies we cover today.
Okay, well, Redrow maybe, and
in fact,
BP possibly.
BP is cheaper as well, actually.
Yeah,
so two of the 5
but also
cheaper.
Also other companies that are heavily regulated.
Yeah, but I think as a rule, tobacco companies tend to be quite cheap. Is the point I was making. Okay. But anyway. PZ Cussons, we've covered them before. They kind of like a mini Unilever. They've got some good brands. They've got like that Natural Sauce. They've got Imperial Leather,
Saint-Tropez,
Morning Fresh.
Okay.
They've got there's another one that I know. Is it Carex? They've got Carex.
Oh yeah, they've got Carex. Yeah,
that's quite a big one. But anyway, that gives you an idea. Sort of like a baby Unilever, certainly in terms of market cap. It's got a market cap of 800 million compared to, I don't know what Unilever is at the minute, but it's been as so they have come out with their half year results and revenue is up 18.8% to 336.9 million. Operating profit is up 60.7% to 39.2 million. Operating margin is up from 8.6% to 11.6%. Profit before tax is up 72.3% to 40.5 million. And basic earnings per share is up 39.5% to 5.9p a share. However, the adjusted earnings per share is actually down 8.5% to 5.16p. They've said like-for-like revenue growth of 6.1% was driven by price/mix improvements with limited volume declines. They've said the must-win brands like-for-like revenue increased 2.2%, and that was 6.7% excluding Carex, with the large majority of the brands in good growth. Reported revenue grew 18.8%, driven by the contribution of the Childs Farm acquisition. And Childs Farm is sensitive skin products. And they've also put the revenue growth down to favourable FX and the impact of additional reporting days in the period. Adjusted operating margin decline of 170 basis points was in line with expectations. So although the operating margin's gone up, the adjusted operating margin is down from 11.6 to 9.9%. They said this is driven primarily by adverse geographic mix, with cost mitigations and revenue growth management largely offsetting underlying inflation, and they're on track for margin improvement in the second half. The adjusted earnings per share declined 8.5% as growth in adjusted profit before tax of 7.8% was more than offset by a higher tax charge and the increase in minority interest as a result of the improved profitability in Africa. On a statutory basis, earnings per share increased 39.5%. The balance sheet remains strong with a new £325 million credit facility agreed, incorporating ESG-linked KPIs. I'm not entirely sure how that works, but as long as they've got the credit facility, I suppose that's the main thing. There were a few interesting points in the slides. First one is free cash flows dropped from 20.3 million to 4.2 million, and the net debt has changed from 3.8 million of net cash to 35.7 million net debt. However, they did have an acquisition in the period, so that is mainly why. Interestingly, in the slides, they've said the 6.1% like-for-like revenue growth was driven by Asia-Pacific and China and Africa, which interestingly is a very different explanation to the one they gave in the statement, which put it down to price and mix improvements. So I don't know why we've got different reasons in there, but anyway. The like-for-like volume decreased 5.4%, so it has mainly come on the back of price increases. They highlighted that the African operating profit has now returned to growth after years of decline. So they actually had decline in operating profits all the way down from 2016 to 2019, which then turned into a loss in 2020, small profit in 2021, higher profit in 2022, and it's now higher again. So Africa does seem to be moving in the right direction. Highlighted that Original Source is the number one vegan shower gel in the UK, which does make sense. It's the number 3 shower gel in the UK shower category per market share, and that's based on market share, and that's up from number 5 previously. I think it could do even better, actually. I think it's a very strong brand. They've given it a foreign exchange analysis. So this is per currency, but as a proportion of the 2022 financial year revenue, 29% of it was sterling, 32% of it was NGN, which I'm assuming is the Nigerian currency, 13% is the Australian dollar, 13% is IDR. I'm not sure what that is. 6% is the US dollar and 7% is other. So it is an international business mainly. Only 29% of the revenue is in sterling. And in terms of the valuation, as mentioned, this is a small business with an £800 million market cap. The dividend yields 3.4% and the PE ratio is 15. In terms of the share performance, that has not done well recently. So in the last 6 months, it's down 12%. In the last year, it's down 7%. In the last 5 years, it's actually down 35%. I thought these were pretty good results. I think the very positive growth figures are a bit misleading because that does include the acquisition. If you strip that out, they're definitely not as good. And a lot of it has come through price increases. But I think there are quite a few things in there where they seem to be starting to turn things around. And at 15 times earnings, with some quite strong brands, I think if they can turn it around, it does have a lot of room to grow. But I think in the UK, there are a lot of very, very good consumer goods companies that you can choose from, one of which we're covering this week on the show. I just think for me to be wanting to pick PZ Cussons above the rest, it would really have to be spectacular. And although it's starting to move in the right direction, I don't feel like it's spectacular. John, what are your thoughts on these results and the valuation?
I think they're pretty good results, and it's clearly going in the right direction, turning it around. The brands are decent. They're not the best. I suppose the difficulty for me would be, like you say, there are better consumer goods companies which are only a little bit more expensive. So I probably wouldn't look at it further than that at the moment. And I'm going to come on to one, Unilever. Yeah, that's probably where I would leave it, to be honest, with Peter Cussons at the moment.
Nick Train had it at one point, didn't he?
I think he did, yeah.
I don't know if he still does, though.
I feel like he might have sold it, but he did have it. Was it? I think it was definitely around 2019, 2020. I remember him talking about it.
So these are old articles. Oh, this one's from Jan 21. He still had it at that point.
Okay. So how has he done on it so far?
Well, he can't do very well based on that. Well, it doesn't. If he bought at any point in the last 5 years, he's not done well. So I found one article. It looks like he's still got it in March 22. In fact, I could just Google the Lindsell Train holding. That's probably the easiest way. There we go. UK Equity Fund. We'll see if it's in that one.
Okay, so
I'll tell you what. In this one, so I'm on the UK Equity Fund.
Okay,
it's like a who's. So he's got experience. He's got Experian in there.
Yeah, I can see. So top 10.
Hargreaves Lansdown. There you go. I'm in good company on that one.
Burberry, Diageo, Unilever, Sage is there.
There's quite a few that we've had in the fantasy portfolio. Celtic. I always like that one. And Man United. That'll be doing well at the minute. Oh, they've got Young and Co's. Do you remember when we did Young and Co's a couple of months ago? I don't know why they've got they've got that Kazoo. AG Bar. I don't know why they'd go for that.
I think that's a VCT.
There's some interesting choices in here. I mean, there's some I remember Rathbones and Schroders, both excellent companies. We've covered them before. London Stock Exchange, excellent company. Hargreaves Lansdown, mixed opinions. Sage, never been overly impressed with that. Experian, I think we have covered it. It seems I don't really understand it, to be honest. Unilever and Burberry, we like those. Relics, I don't really know anything about that. I'm surprised Young and Co's is in there. AG Bar, Diageo, Fever Tree. He likes his drinks. I can't see it's still in there.
It's not one of the top 10. I'm just going off track now. I'm looking at his US fund. He does it. Equifax is in there. American Express, Disney is in there as one of the fourth largest holding. Nike is the 6th largest holding. PepsiCo is the 7th.
We could quite easily do an episode just going through some of these and just having a natter, I reckon. But anyway, the point, it looks like I don't know which fund it was in originally, but it's not in the main fund now. So it looks like it has been sold, but we're not 100%. Anyway, should we move on to a company that is in Nick Train's main fund, and that's Unilever?
Unilever, yeah. So it's the daddy. It's the FTSE 100's largest consumer goods company and owner of brands from Marmite, Dove, Lynx, Ben & Jerry's, and many, many more. If you look around your house, the chances are you'll probably have quite a few Unilever brands, but you just don't realise it. Anyway, they had their full year results out last week, with full year revenue up 14.5% at 60.1 billion euros, including a 6.2% headwind from exchange rates. Underlying sales growth was up 9%, driven by all divisions, with price growth of 11.3%, more than offsetting a 2.1% volume decline. Beauty and Wellbeing saw underlying sales growth of 7.8%, Personal Care 7.9%, Home Care 11.8%, Nutrition 8.6%, and Ice Cream up 9%. Underlying operating profit was broadly flat at 9.7 billion euros, with higher costs offsetting the jump in sales, leading to underlying operating margin down 2.3 percentage points to 16.1%. Free cash flow came in at 5.2 billion euros, down from 6.4 billion euros last year, with an increase in capital expenditure and investment in inventory. Brand and marketing investment was up by 500 million euros. Meanwhile, net debt fell by 1.8 billion euros to 23.7 billion euros, which is roughly 2.1 times EBITDA and roughly in line with the target of 2 times. Going forward, price growth is expected to continue into the first half. Underlying sales growth expected to be towards 5% for the full year. The chief executive, or the outgoing chief executive, I should say, commented that Unilever delivered a year of strong top-line growth in a challenging macroeconomic environment. Growth was broad-based across each of our 5 business groups, led by strong performances from our billion-plus euro brands. Despite sharp price rises in material costs, we have prioritised stepping up our brand and marketing investment. We continue to improve our growth profile with the sale of the global tea business and the acquisition of Nutrafol. The group had also earlier announced the new chief executive, Hein Schumacher, who is to take the reins in July. In terms of the valuation, Unilever has a market cap of £107 billion and trades at 17 times forward earnings, compared with a 10-year average of 19, and it yields just under 4%. I think these results are definitely better than expected, and with inflation beginning to ease, continued investment in the core brands, and I think the optimism as well regarding the new chief executive, I suppose streamlining Unilever and focusing more on those core brands, hopefully releasing the value to shareholders. And again, hopefully moving away from some of the random purchases that they've made with companies like Dollar Shaving Club in recent years, and then the attempt for Haleon in the summer. It can become focused and we can really see Unilever driving growth going forward. That's certainly what I'm hoping for. I think that's reflected in the share price, and the shares have been doing well in recent months, I think largely as a reaction to that. And the underlying numbers, I would say, pretty good. It's not nice to see any volumes fall, but given how much they've been hiking prices and only seen volumes drop a relatively small amount, I think that's a positive, and hopefully that won't be the case as inflation settles down going forward. It's got some fantastic brands, and I'd be optimistic about the next 5 years with Unilever, with the new chief executive in place. Sam, what are your thoughts on these numbers and potentially a change in strategy at the top with a new chief executive?
I think the numbers are pretty good. They've had a bit of luck on the exchange rates, but nothing they can do about that. Even if you strip that out, I think it's a decent amount of growth, underlying sales growth of 9%. I think it is a testament to the quality of the brands that they are able to do that. And that is, I think, one of the reasons why people have been willing to pay up for these shares in recent years. Because irrespective of the performance, they've got some very, very good brands. I don't think the debt's at particularly concerning levels. It's got a strong dividend. Do we know anything about the incoming CEO? Do you know where he's coming from?
So he'd previously, before going to the European dairy giant Royal Friesland Campina, he'd been at Kraft Heinz.
I thought he might have been Kraft. I thought I might have seen something saying that. Kraft's got some fantastic brands as well. So it seems like a fairly decent appointment on the surface. I think the main thing, it's more to do with the fact that the previous CEO is outgoing. So I don't think he's done a particularly good job. So yeah, no, I think it's probably the most optimistic I've been since we've covered it on the show, and hopefully we can start seeing it. Well, hopefully start putting up with regularity the sort of results we've been seeing from Nestle, because I think the brands are as good. So we move on to BP.
Yes, biggest company of the week. Minus Disney.
No, it's not. It's £101 billion market cap, smaller than Unilever.
Oh, yeah, okay.
Sorry.
Ooh.
Would Shell have been bigger?
Fine. Oh, yeah. Not quite double, but let's see.
Oh, right, okay. So BP, the oil company that I'm sure we're all familiar with, they have come out with their Q4 results. What?
I took Shell off my watch list because I sold it in December at £24.50, and since then it had been down, but now it's £25.40.
Yeah, you were unlikely to have got the exact time.
I know.
Just close the tab, move on. We're doing BP. Forget about Shell. Right,
176 billion market cap. Anyway, I'll be quiet.
That's big. Right, so BP have come out with their Q4 results, and underlying net profit for the quarter totaled $4.8 billion, and these figures will all be in dollars. This was over 40% below the exceptional performance in the previous quarter, but was still enough to allow BP to score a record result for the year, with profits more than doubling to $27.7 billion. This reflects a 48% average increase in the price of oil and gas achieved for BP's oil production and operations. Free cash flow in 2022 was $28.9 billion, up from $12.7 billion. Net debt fell by 30% year on year to $21.4 billion. That is a good chunk of debt they have paid down. BP announced a dividend of 6.61 cents and intends to buy back a further 2.75 billion of its own shares before the release of its first quarter results. In the first quarter of 2023, BP expects the oil price to remain supported by improving Chinese demand and the uncertainty surrounding Russian exports. The gas price is expected to depend on weather in the northern hemisphere and also the pace of Chinese demand recovery. Refining margins are expected to remain high, with lower levels of downtime than seen recently. Oil and gas production is expected to be broadly flat. BP has also released a strategy update confirming up to $16 billion of investment out to 2030, split evenly across projects in the energy transition and oil and gas. In terms of valuation, the business is the cheapest we've covered on the show this week. It is a forward PE of 5.7. That compares to a 10-year average of 12.3. And the prospective yield for the next 12 months is 4.3%. I think this fantastic set of results. I'm always concerned with these businesses that it is a cyclical and they do look best at the top of the cycle. But I think they're doing a lot of things right. And I think paying down 8 billion of debt, I think that's really, or whatever it is, it'll be about 8 billion. But I think that's really smart. That debt now, 21.4 billion of net debt compared to profits for the year of 27.7. I mean, you're not concerned with that at all. I appreciate they might be abnormal profits, but you know, when they're paying off the debt that fast, I think the profits are being wisely put to use. So I think these are excellent results, as you would expect in the current environment. I think the business is pretty cheap, but I'd be concerned about the cyclicality of it. And my other concern is that just the political issues surrounding this stock. I won't go into them too much because we covered Shell a couple of weeks ago, and I think John explained his concerns with the political issues surrounding the stock. But my concern would be, as a shareholder, as good as these results are, you don't know how much of it is actually going to flow through to you in the long term, and how much is just going to be paid in taxes for supernormal profits. And that would be a serious concern for me. I think, again, John touched on this with Shell a couple of weeks ago. I know it's not huge amounts, but the investments I don't like the fact the investment is being split between energy transition and oil and gas. I sort of get that, you know, they kind of like with tobacco, they want to have a future, but if it's not really commercially viable yet to be investing in these renewables, I think they're better off just putting more into oil and gas. And if an investor wants to take a punt on renewables, they can do that via a separate investment vehicle that's specifically set up for that. I don't buy BP, not that I'd buy it anyway, but I wouldn't buy Shell or BP because I'm wanting a sustainable investment. Like, it's not something I'm doing to get my ESG score up. That's not why you buy an oil company, if we're being brutally honest. And I think I think the management would be better just acknowledging that and just doing what they're there to do. John, what are your thoughts on these results and BP as a business?
I mean, excellent results, but it's like you said, and like we said last time with Shell, it's the political interference that really worries me, because these companies are cyclical, and if you're being smashed with taxes at the top of the cycle and you're not being helped out when you're at the bottom of the cycle, you don't do well out of that as a shareholder. I'm not keen on a lot of the profits being invested into the energy transition. I would prefer a pure play oil and gas company. I appreciate you probably don't get any now that are completely pure play, but BP is investing more than Shell, and Shell, as a proportion of its profits, are investing more than some of their US peers. That's another worry. I suppose you'd counter that and say, well, Shell and BP are considerably cheaper than their US peers, but it's for those reasons. It's the political interference is the thing that really just tipped it over for me, and it's why I shall sold my Shell shares. If I had BP shares, the same would apply, to be honest. It's a shame, but I think we've just crossed that Rubicon in the political sphere in the UK. And it's not one party, that it's both parties which are doing it. And the better the results are, the higher the taxes go. The goalposts are constantly being moved. And there are a lot of people here in the UK who don't think they're high enough still. So I think that I don't know whether I go as far as uninvestable, but it was enough for me to sell my shares.
I don't really have anything to add to that. So should we move on to another cyclical business?
Yeah, another cyclical business, but one that I think we both do like. We certainly like the sector. It's Redrow, which is a FTSE 250 listed house builder. We have covered it before. They had their half-year results out for the 26 weeks, ended 1st of January. Revenue fell by 2%, just over £1 billion, with profit before tax also down 2% at £198 million. Legal completions were down 10% at 2,485, and the order book fell by 27% to £1.1 billion. Operating margins were broadly flat at 19.3%, and the group reported a positive start to the second half, with a volume of private reservations per outlet per week for the 5 weeks to the 5th of February of 0.51. Going forward, the group had previously guided for revenue of £2.1 billion, which they've now cut back to £2.05 billion, and operating margins are expected to remain broadly flat. With the current market conditions, they've withdrawn the guidance for 2024, and there's a statement from their chief executive, Matthew Pratt, saying, Redrow's proven business model has played an important role during a time of significant political and economic uncertainty. We have award-winning homes and places, a strong forward order book, land acquired in the last few years at good margins, and current cash reserves of £107 million. This is despite completing a £100 million share buyback exercise on the 13th of January 2023, just after the financial half-year under review. We have experienced a positive start to the second half trading, whilst 2023 will be challenging as the market resets. Early indications are better than anticipated, and the market appears to be finding a new natural level. Redrow has become the first large house builder to begin selling homes which will incorporate air source heat pumps as standard. Underfloor heating will also be provided as standard on ground floor in our detached homes. Furthermore, we are once again tracking a 5-star level of customer satisfaction and remain excellent on Trustpilot with a trust score of 4.5. I thought these results were perhaps not as bad as expected given the mini budget, but it's clearly concerning that the order book fell by 27%. I think there are encouraging initial signs, and you're seeing that mortgage rates are coming back down. I still remain bullish on the long-term fundamentals of the UK housing market, with the chronic undersupply and the big house builders' role in addressing this. Its valuation, it's a market cap of 1.7 billion, and it trades at the price to book of 0.89, with a prospective dividend yield of over 6%. I think it's very cheap. It's obviously very cyclical. It's a company, though, that I think with those long-term fundamentals, I like. It's a sector I like, and I'll be holding on to the shares and reinvesting the dividends whilst things are cheap. Sam, what are your thoughts on Redrow, these results, and the house building sector in general?
Yeah, I think given how the last sort of 6 months or so have been in the economy, I don't think there's anything overly surprising in these results. But it's still very interesting as a bellwether of the economy. I think this is the first proper set of results where it's clearly having, basically the interest rates are clearly having an impact on the house purchases. Previously, we've seen a couple of them starting to wobble a bit where the order book's not been quite as good, but the revenue growth's still there and the completions is still there. And now we're actually starting to see declines. And I think this is the first one we've seen with that. I know you mentioned that the interest rates are starting to come down a bit, but I would say we're still at 10% inflation. So in the short to medium term, I think the interest rate has to continue going up and mortgage rates should follow. So I don't think it's going to get better anytime soon. That being said, long term, I do like it. We've covered the industry numerous times. We do have a house builder on probably every other week, but it is a very, very attractive industry for a number of reasons. The main one is that there's an undersupply of housing. If I think about 100,000 homes a year, and like John says, the bigger house builders have to have a role in addressing that, but they are still cyclical. And it's all well and good building more houses, but you do have to sell them. And I think with interest rates going the way they're going, I think there could be a tough few years ahead. If you're asking me, do I like the stock for 5-10 years' time? I absolutely do. I think it's a very, very, I mean, Redrow, I think, is one of the higher quality house builders. I think it's very, very good business. It's got excellent margins. I mean, yeah, I mean, those operating margins, they're higher than Unilever's. I know it's a completely different product, but it is interesting, isn't it, that they are making such high margins on a house. But then, and then politically, they're not really coming under that much fire because we need to be building more homes. So although there is like a special tax on house builders' profits if they're over a certain threshold, but if you compare that to say oil and gas, which we've just covered, nowhere near as politically charged. Yeah, I think in the short to medium term, I've got quite a few concerns. I think this is the start of a trend. I think interest rates have to continue going up if we want to address inflation. But in the long term, I like the industry and I like the stock.
Fair enough. I do agree to some extent with the interest rates, but do you see the end in sight with the hikes?
I don't know, because I think we're still at 10% inflation.
Yeah,
it's not like the Bank of England can put their feet up and say job done and light a cigar. It's just they've got to go up further, and the only reason they're going up so slowly is because because like the financial markets have a fit every time they do, and also because we've got. I mean, I'm ranting a bit now, but also because we've got a generation almost of home buyers that have taken out homes at very expensive prices on very low mortgage rates, and when it comes time to remortgage, a lot of people are going to get absolutely shafted. But it doesn't change the fact that inflation needs to be addressed. But I think you're going to have quite a lot of people who bought homes in the last 5 years that are sat in negative equity for the next few years. People who bought at the very top of the cycle. I think it's going to be very interesting to watch. But if you bought a home, say 3 years ago, I do feel quite sorry for you if you're listening to this, because I don't think it's getting better. I think it's going to get worse before it gets better. And it's fine, because if you don't want to move, it's not an issue. But we've seen before, we are a nation that measures our wealth on house prices. So, so even if you've got people who aren't planning to sell their homes, if they know they're in negative equity, even though it's not really an issue, it does affect their behavior a lot.
Yeah. And I suppose it's one of those things as well. It's very easy to check almost your house in real time when you can have a Rightmove app a couple of taps away.
Yeah, and it's kind of like stocks, isn't it? Like, I know you shouldn't do it and you know not to do it, but the reality is, like, if your portfolio is doing really well and you're like, on paper you might have made, say, 10 grand in a week or something, you might go out and treat yourself to a meal because you've made so much on paper. And then, like, 2 weeks later, you're down 20 grand, but you still paid for the meal that's not coming back that you bought when you were feeling flush. It is just the way people behave. Like, there's a lot of psychology to it. But yeah, I'd be interested to see a few more of the house builders and also the next few quarters to see if it carries on. But I think it will. But in the long term, I do like the industry and the stock.
Yeah, I mean, it's not Redrow specifically, but I have held a house builder for, how long would it be now? At least maybe 7-8 years, something like that. And in that time, share price wise, they've been extremely volatile with things like Brexit happening. And I remember I held Taylor Wimpey, must have held it at under £1, over £2, and then everywhere in between. So that was a bumpy ride, but it's been one of those stocks just to hold and reinvest the dividend, like the long-term thing. So I don't worry too much or try and time the cycle with it. But yeah, I appreciate some of those issues that you raised, Sam, and I don't necessarily disagree with those. But if you're in it for the very long term, it's probably something you don't need to worry too much about. I guess it's maybe if you're a bit nervous about taking a position, your first position now, but I would say if you're in it for the long term, it's not something that should necessarily be too worrying for you.
But I would say if you're looking at it now, you are getting it quite cheap. So, you are potentially getting those rewards later on if you don't mind a bit of short-term volatility.
Yeah.
But like Redrow, it's 38% cheaper than it was 3 years ago.
Yeah.
And you are getting a very good dividend from it. That dividend might come down, but once it's back, it's cyclical and it will get back to this position again. So no, I do like it.
Yeah. Okay.
Should we move on to another business that we like?
Oh yeah, we can both agree on this one.
So probably the favourite of the show, Disney. They have come out with their Q1 results. So I'll start with Bob Iger's statement, who is the former CEO, but now CEO again after Bob Chapek took over a couple of years ago, which didn't really work out. So Bob Iger has said, after a solid first quarter, we are embarking on a significant transformation, one that will maximise the potential of our world-class creative teams and unparalleled brands and franchises. We believe the work we are doing to reshape our company around creativity, whilst reducing expenses, will lead to sustained growth and profitability for our streaming business, better position for us to weather future disruption and global economic challenges, and deliver value for our shareholders. So revenue is up 8% to $23.5 billion, and all these figures are in dollars. And net income from continuing operations is up 11% to $1.28 billion. Diluted earnings per share from continuing operations is up 11% to 70 cents a share. And free cash flow is down 81% from a $1.19 billion outflow to a $2.15 billion outflow. In terms of the segments, media and entertainment distribution was up 1% to $14.776 billion, and Disney Parks experiences and products was up 21% to $8.736 billion. We break the revenues down a bit more. In the media and entertainment distribution section, linear networks were down 5% to $7.293 billion. Direct to consumer was up 13% to $5.3 billion, and content sales, licensing and other was up 1% to $2.46 billion. And for the operating income, direct to consumer losses worsened by 78% from $593 million to a $1.05 billion loss. In the direct to consumer, they've said direct consumer revenues for the quarter increased 13% to $5.3 billion, and operating loss increased $500 million to $1.1 billion. The increase in operating loss was due to a higher loss at Disney Plus and a decrease in results at Hulu, partially offset by increased results at ESPN Plus. Results at Disney Plus reflected higher programming and production costs and increased technology costs, partially offset by higher subscription revenue and a decrease in marketing costs. The increase in programming and production costs was attributable to more content provided on the service and higher average cost per hour, which included an increased mix of original content. Higher subscription revenue was due to subscriber growth, partially offset by an unfavorable foreign exchange impact. The decrease in results at Hulu was primarily due to higher programming and production costs and a decrease in advertising revenue, partially offset by subscription revenue growth. The increase in programming and production costs was attributable to an increase in subscriber-based fees for programming the live TV service, more content provided on the service, and higher average cost per hour. The improvement at ESPN Plus was due to growth in subscriber revenues attributable to increases in subscribers and retail pricing. And as of 31 December, the paid subscribers for Disney Plus were up slightly from 46.4 to 46.6 million in US and Canada, up 2% in international, excluding Disney Plus Hotstar, to 57.7 million. And that gave Disney Plus Core a 1% increase to 104.3 million. Disney Plus Hotstar, which is like the cheaper service in the emerging markets, I think, that was down 6% to 57.5 million. So total Disney Plus was down 1% to 161.8 million. ESPN Plus was up 2% to 24.9 million, and Hulu was up 2% to 43.5 million. The average monthly revenue per paid subscriber for domestic Disney Plus decreased from $6.1 to $5.95 a month, driven by a higher mix of subscribers to multi-product offerings, partially offset by an increase in retail pricing. The average monthly revenue per paid subscriber for international decreased from 5.83 to 5.62 due to unfavorable foreign exchange impact. In terms of the valuation, the business trades at a P ratio of 24.8, and that compares to a 10-year average of 23.2. And Bob Iger has announced he intends to reinstate the dividend, which, for the record, I disagree with. I would rather they paid off some of the debt that they've got. They do have a decent amount of debt from the Fox acquisition. However, shareholders do love dividends, so that gave the stock a bit of a boost, irrespective of whether it was the right decision. But it does have a prospective yield for the next year of 0.6%. I thought these were mixed results. I think the revenue numbers are very good. I've not really gone into it because I do tend to focus on the direct consumer, which is what I think is going to be the growth driver for this business going forward. But the parks were putting up excellent figures as well. I don't know how I feel about the Disney Plus subscribers. So the Hotstar decline, I don't really mind that much because it's the cheaper service that's like in the emerging markets, and it's not the core Disney Plus offering, which was up slightly. And it was up very slightly, but in a very tough economic climate. So I think to hold its own, on balance, it's probably a good thing, but I would like to see it continue growing. I don't like seeing the average revenue per subscriber dropping as well. I don't mind them dropping it if it's leading to an increase in subscribers. I appreciate some of it's on exchange rates, which they can't help. But I would like to see them get back to growth with that. I do think the strategy they've been adopting is the right one. That doesn't necessarily mean they can't do it more efficiently. So they've announced 7,000 job cuts and they are cutting costs. I don't see why they can't do it efficiently. I think they've got some very good brands that with the Disney Plus, they could have a much narrower content offering than Netflix and people would still pay for it. I've said it before, like I'm quite happy to pay whatever it costs really for the new Star Wars content every year. I will just pay up for it and watch it because I do really like that universe. And there's other people that are the same with like Marvel, or if you've got kids, you might want all the Pixar stuff. I think they've got a lot to offer. Plus they've got the huge back catalogue. But I think the strategy for now is they should be growing the number of subscribers. So it is a concern when that isn't happening. However, this is the first quarter we've seen this. And since inception, it has done fantastically well and is probably much further ahead than we would have expected at this stage. So mixed for me, but as a shareholder, I'm pretty happy overall and I continue to hold it. John, what are your thoughts?
Yeah, I would largely echo that. I think it's a relatively minor setback in the scheme of things on the subscribing front. And I think the quality of content they've got behind them with the direct consumer, I think that's strongly supportive of growth going forwards. It's also got the parks business, which on this occasion is, propping it up, and perhaps, post-COVID is now going to be that reliable revenue that it always has been. But it is Disney Plus, and I'm still very bullish on that. So I continue to hold shares. I added to them relatively recently, but with Bob Iger at the helm again, I'm even more optimistic than I was.
So of the 6 businesses we've covered this week, British American Tobacco, PZ Cussons, Unilever, BP, Redrow and Disney. If you had to buy one, which one would it be? Excluding the fact that you already own several of these.
Okay. I would go for Disney. But if I were to, it's maybe a little bit unfair in terms of the comparison. If I were to go for a UK listed one, it would be Unilever. But Disney would be far and away that if it were one company, and we could include the US one.
I would agree with Disney. We said it before, but I do think it's the best business in the world. Certainly in terms of the product, I think there's a few things operationally they could be doing better. I've said it before, but I mean, for example, I've watched Snow White, the cartoon. My parents have probably watched it. There's a good chance my grandparents have watched it, and there's a very good chance if I have kids that they will watch it. And how many other films from 1937 can you say that about? I think some of the brands they've got are just magical. If we exclude Disney, I think probably I would go for British American Tobacco. I like the valuation, and I like the way the next generation is going.
Thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.